Welcome to Iron Financial. I'm your lead analyst, and today we're executing a full top-to-bottom structural inspection of the latest earnings report from an absolute giant in the industrial space. We are talking about Sherwin-Williams. Our mission with this explainer, as always, is to help you forge a much stronger portfolio and completely cut through the widespread market weakness we're seeing right now. Listen, there's no sugarcoating it. The global industrial space is facing a serious, undeniable contraction. Manufacturing PMIs are dipping into the red, freight volumes are down across the board, and a whole lot of heavy-duty industrial players are flashing bright red warning signs. We don't just look at the shiny exterior paint job here. We take our tools and we drill down deep into the revenue, the debt, the margins, and the raw numbers to see if a company actually has a foundation of solid steel, or if the whole thing is just sitting on a massive sinkhole.
And I'm the market skeptic. I'm here to ask the exact questions you're sitting at home wondering about. Because honestly, right now the market is absolutely flooded with companies posting these flashy headline numbers. But the second you start looking under the hood, or, pulling back the drywall, you start seeing the structural cracks. We need to know if Sherwin-Williams is actually a heavy-duty, long-lasting material for your portfolio, especially when so many of their direct peers are actively struggling just to keep the lights on and the factories running.
So let's just jump right in, put on our hard hats, and get to work. Sherwin-Williams just posted a 6.8% year-over-year sales growth in the first quarter of 2026. Now, I'll admit, that sounds incredibly impressive on paper, but I'm playing the strict building inspector today. We are operating in a macroeconomic environment where the industrial sector is facing massive, hurricane-force headwinds. Shifting consumer demand is a huge concern. So I really have to ask, is this sudden earnings bump built on solid ground? Let's be real, the post-pandemic DIY boom has completely dried up. Homeowners just aren't rushing out to repaint their living rooms or their decks anymore because inflation is actively eating away at their discretionary spending. So with that DIY market drying up and borrowing costs still painfully high, is management just applying a fresh coat of paint over a crumbling, deteriorating market just to make the financials look pretty for Wall Street?
That is exactly the right question to ask. And honestly, it's why we don't ever just take management's word for it. You can't just take a single quarter's top-line pop and automatically assume the entire skyscraper is structurally sound. You absolutely have to verify the strength of the materials yourself. Let's actually look at the hard earnings print to see exactly how this 6.8% growth materialized in reality and figure out whether it's truly enough to support the massive weight of their current valuation.
Section 1. The Blueprint. Wall Street Estimates versus Q1 Actuals. Okay, to truly understand if a company is outperforming, you always have to measure it against the original architect's plans. The market had set a very specific bar for Sherwin-Williams coming into the first quarter of 2026. The architects over on Wall Street set the blueprint at $5.55 billion in revenue and $2.27 for adjusted earnings per share. But Sherwin-Williams delivered actuals that blew right past those marks. They pulled in $5.67 billion in top-line revenue and a non-GAAP profit of $2.35 per share.
Right, sure. But we all know a beat is really only as good as the expectations it exceeds. If the bar was lowered artificially by cautious, nervous analysts over the last few months, then simply clearing that bar isn't exactly a sign of immense structural strength, is it? It's just stepping over a tripwire.
Actually, they didn't just clear a lowered bar. They cleared it with absolute authority. That translates to a 2.1% outperformance on revenue and a solid 3.6% beat on earnings per share. Consolidated net sales were up 6.8% year-over-year, and net income came in at a massive $534.7 million. Listen, moving raw volume in this current market environment is incredibly difficult. When you have ongoing supply chain hangovers and high interest rates actively squeezing buyers' wallets, seeing a solid beat on both the top and bottom lines tells me something crucial. It tells me the company isn't just ruthlessly firing people and cutting costs to manufacture a fake earnings beat, they're actually pushing real volume out the door. This is genuine proof of a strong foundation. Well, let me pump the brakes for just a second here. You're getting super excited about the numbers, but I'm actually listening to the people running the daily operation. Their own CEO, Heidi G. Petz, came out and explicitly stated that they delivered strong sales in a quarter characterized by, quote, heightened global uncertainty and continued demand softness in most end markets.
Come on, that's just standard corporate speak. Executives literally always manage expectations down to give themselves some breathing room for the rest of the year.
No, I disagree entirely. That's not just corporate speak. That's a direct flashing warning light about macroeconomic headwinds stressing the building's exterior. She's openly admitting to everyone that demand is soft out there right now. And I have to ask, what does heightened global uncertainty actually mean in practical terms for a company so heavily tied to housing and industrial manufacturing? Mortgage rates are locking people into their current homes, meaning they aren't moving, which completely kills the residential repaint cycle. Plus, industrial capex is noticeably slowing down. If the fundamental end markets are weakening like she says, how long can Sherwin-Williams continue to defy gravity? I'm challenging the whole bullish narrative here. A strong Q1 doesn't mean the roof isn't going to start leaking in Q3 if a global recession officially hits.
Section 2. Stress testing the foundation. Analyzing historical growth trends.
Look, I completely acknowledge the macroeconomic weather report. Yes, there is massive uncertainty out there. And yes, industrial output isn't exactly booming on a global scale. But numbers do not lie. Despite every single one of those headwinds you just mentioned, the impressive 6.8% year-over-year revenue spike this quarter demonstrates true structural integrity. They aren't just surviving the storm, they are actively expanding their footprint in a very, very tough neighborhood.
Well, if that's true, then it's time to conduct a real stress test. Look, any business can put up a good quarter or two by pulling the right levers or running a promotion. But enduring, ironclad businesses grow consistently over years. Let's pull back the camera. I'm going to take my hammer and really tap on the load-bearing walls here. The historical blueprint shows a 5-year compounded annual growth rate of just 4.9%. That falls quite short of the benchmark you'd want to see for the broader industrial sector. And honestly, it gets worse. If you look at the 2-year annualized revenue growth, it decelerates all the way down to a sluggish 2.1%.
But that simply reflects the broader market slowdown we were literally just discussing.
Exactly. That's my point. It signals changing consumer tastes and a hostile environment. So how on earth are they suddenly printing a 6.8% year-over-year jump in Q1 2026? If the building has been settling slowly for 5 years with sub-5% growth, why the sudden jolt upward? This 6.8% looks like a massive anomaly against a long history of decelerating trends. And as an inspector, an anomaly is always a major red flag. Is this a one-off magic trick, or is it a real structural turnaround?
I'm telling you, it's not a magic trick. It is operational excellence at its finest. I will defend this structure right now by pointing you directly to the steel I-beams of any good business, the margins. Top-line revenue can always fluctuate with the seasons, but margins tell you if a company actually has real pricing power in the market. The operating margin came in at a rock-solid 14.3%, perfectly stable and completely in line with the exact same quarter last year.
Okay, stable operating margins are good. I'll definitely give you that one. It means their internal cost structure is holding up under the weight.
It's way better than good. Their gross profit margin actually expanded to a massive 49.1%, generating almost $2.8 billion in raw gross profit for the quarter. Let me ask you, how do you generate $2.8 billion in gross profit in a soft market? You do it by rigorously stabilizing your raw material costs, things like petrochemicals and titanium dioxide, while strictly maintaining the aggressive price hikes you push through during peak inflation. They didn't roll prices back. They are heavily managing their costs, executing highly targeted pricing actions, and proving that their internal cost structure can completely withstand external economic pressure. That, my friend, is the exact definition of a durable portfolio asset.
Market Skeptic, Section 3, Financial Engineering, the buyback scaffold.
Okay, the margins might be holding the building up, but I want to pivot this inspection toward the bottom line, specifically how that earnings per share is actually being supported. In this current market, we are seeing a massive amount of corporate tricks being used to dress up the numbers and make things look prettier than they are. I want to know if the 3.6% EPS beat we saw earlier is the result of purely organic, ground-up business growth, or if it's being artificially engineered by the folks in the finance department. And here is the smoking gun I found. Sherwin-Williams has been aggressively repurchasing its own stock, effectively shrinking the overall share count by 3% over the last 2 years alone. Let me explain the math of this buyback scaffold for a second. When you take the exact same amount of net income and you divide it by a shrinking pool of outstanding shares, the earnings per share automatically inflates. It goes up even if the actual net income of the business hasn't grown by a single dime.
That is just returning value to shareholders. Plain and simple, it's a hallmark of a mature company.
No, it's financial engineering. These buybacks act as a temporary scaffold to artificially reinforce the EPS structure. It heavily masks the fact that underlying operational efficiency might not be improving nearly as much as the headline earnings number suggests. If you take away that buyback scaffold, does the entire earnings growth collapse? Let me counter that right now. Yes, financial engineering is doing some of the heavy lifting. I won't deny that. But let's look at the reality of the metrics side by side. Even with a sluggish 2-year annual revenue growth of 2.1%, their 2-year annual EPS growth sits at a very sturdy 5.0%.
Right, because of the buybacks. You just proved my point.
Because of smart, calculated management, the bottom line is still growing significantly faster than the top line. Listen, when organic growth is incredibly slow due to harsh, unavoidable macro conditions, taking your massive free cash flow and buying back your own undervalued shares is a structurally sound capital allocation strategy. It is infinitely better than blowing that hard-earned cash on reckless, overpriced acquisitions just to force top-line growth to appease Wall Street. They aren't artificially inflating sales through excessive, unprofitable spending on advertising. Their incremental sales are highly profitable. Whether it is true organic growth or smart share retirement, it still results in a much stronger yield for the investor who is actually holding the stock. The iron here is solid, scaffold or no scaffold. Section 4. Segment breakdown. Who is doing the heavy lifting? Let's step away from the high-level corporate view and move this inspection to the individual floors of the business. You have to remember, Sherwin-Williams isn't just one single product on a shelf. It's a massive, highly diversified entity. We need to break down exactly which divisions are supplying the real revenue load. Here is the raw blueprint. All 3 of the reportable segments contributed to the consolidated net sales growth. The Paint Stores Group brought in $3.05 billion with a 3.7% year-over-year growth. The Consumer Brands Group hit $900 million with a massive 19.2% spike. And the Performance Coatings Group delivered $1.71 billion with a very sturdy 6.5% growth.
Market skeptic? Well, all segments are in the green, which is admittedly impressive. If one floor is crumbling while the penthouses are booming, the whole building is still at risk of coming down. But here, every single floor seems to be holding weight.
Exactly. But I really want to point out the sheer massive scale of the Paint Stores Group. At over $3 billion in revenue for just one single quarter, this segment is the massive load-bearing pillar of the entire Sherwin-Williams enterprise. When this specific division is healthy, the whole structure stands tall. And let's drill even further into that Paint Stores Group. They posted a 2.4% bump in same-store sales, but the absolutely crucial detail here is where that strength is actually coming from. It is not just weekend DIYers buying a gallon of eggshell white for their living room. The growth was driven heavily by the professional end markets.
So you're talking about the big industrial contracts and professional commercial painters?
Right, exactly. Protective coatings, marine applications for shipping, and large-scale residential repaints. These are professional contractors and massive commercial builders. You have to understand why pro demand is so crucial to this foundation. It is incredibly sticky. Commercial contracts are long-term. Property managers have to paint apartment units between tenants regardless of what the broader economy is doing. It is non-discretionary maintenance. They can't just skip it. When the pro market is actively buying, it proves that the underlying demand in the actual economy is real, resilient, and not just a pandemic-era home improvement hangover. This specific segment is completely fortified with iron. All right, fair enough on the pro side, but let me direct your attention to the Consumer Brands Group for a second. A 19.2% spike in growth? In this economy, with the DIY market drying up like we just established, that immediately triggers my skeptical alarm. And sure enough, when you look at the underlying drivers of that number, it is not purely organic demand. But they expanded the segment margin to an impressive 21.7%, which is fantastic operational execution no matter how you slice it. Yes, I see the margin expansion, but the massive revenue spike itself is heavily bolstered by the October 2025 acquisition of Suvinil, combined with a favorable foreign currency translation and some higher European sales. My point is, they did not grow this division by 19% organically from the ground up. They literally bought that growth. As an investor, you have to separate true organic demand from top-line bumps that you simply wrote a massive check for. Acquiring a company in October 2025 heavily skews a year-over-year Q1 growth comparison. It makes the headline number look like an absolute powerhouse, but realistically, it's structural hype. Okay, but even if you discount the recent acquisition, the overall portfolio remains incredibly durable. Let's finish our segment tour with the Performance Coatings unit. They posted a very sturdy 6.5% growth, bringing in $1.7 billion.
And what is the real underlying driver of that growth?
True industrial strength. We are talking about notable unit strength in automotive refinish, general industrial applications, packaging, and coil. This adds a massive, critical layer of diversified durability to the overall company, because these are true all-weather assets. Think about it. If consumer housing slows down entirely, their industrial, auto, and packaging divisions can easily absorb the shock. People still get into fender benders during a recession, and those cars need auto body paint to be repaired. Food and beverage packaging requires specific high-grade coatings regardless of what inflation is doing. This is exactly how you build an all-weather portfolio asset that doesn't collapse when one single sector takes a heavy hit.
Market Skeptic, Section 5, The Verdict, Opportunity or Trap.
So we have thoroughly tapped the walls, we've checked the margins, and we have examined the blueprints in detail. The foundation is stable, but there's definitely some financial scaffolding holding up the EPS and some strategic acquisitions artificially boosting the top line. Based on this complete Q1 structural check, is buying into the Sherwin-Williams earnings bump a brilliant opportunity to forge your portfolio, or is it a value trap just waiting to cave in?
For me, the verdict is completely sealed by management's forward-looking statements. They officially reaffirmed their full-year 2026 adjusted earnings per share guidance of $11.50 to $11.90. You really have to understand the macro context here. We are in an earnings season right now where CEOs across the board are aggressively slashing guidance and issuing profit warnings at the first sign of a cloudy day. Reaffirming your targets in this highly uncertain environment is a massive flex.
It shows serious, unwavering confidence, I won't deny that.
It is the ultimate proof of a solid foundation. And Wall Street completely agreed with this assessment. The stock traded up 2% to nearly $343 immediately after reporting. They are navigating immense global uncertainty with real pricing power and margin expansion. As a trader, this looks like prime structural steel for a long-term hold in any portfolio.
Well, let me summarize the final findings of the inspection so everyone can make their own call. The Iron Financial Inspection Report shows undeniably solid top and bottom line Q1 beats, backed by a very stable 14.3% operating margin. They are profitable and they are defending their pricing power exceptionally well.
Highly profitable and extremely durable.
True. However, you have to balance that impressive Q1 against the longer-term reality of the situation. The EPS is absolutely being artificially engineered by a 3% share shrink, and the massive revenue spike in consumer brands was largely bought via the Suvinil acquisition rather than grown organically. Furthermore, you really must separate the headline hype of a 6.8% bump from the historical reality. Their long-term 5-year growth trend still remains a rather tepid sub 5%. So while the foundation holds, there are absolutely some minor cracks in the armor, if you look closely enough. And that brings us to our final question for you. We have laid out the blueprints, we have stress-tested the margins, and we have exposed the financial engineering holding up parts of the structure. Now it is your turn to be the architect of your own wealth.
Exactly. Is Sherwin-Williams strong enough to act as the heavy-duty material your portfolio actually needs to weather an uncertain economy? Or is this 6.8% Q1 bump just structural hype, masking a long-term slowdown in true organic growth?
Do your own due diligence, weigh the evidence we've presented today, and make the hard calls. Thanks for joining us for this structural inspection on Iron Financial. Until next time, keep your foundation strong and your portfolios forged in iron.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.